Want to get a quick check on the markets this morning. Uma Paterkini is joining us, investment strategist and ESG lead at Center Square Investment Management. Center Square has $15 billion in assets under management. Also joining us this morning is Kevin Nicholson. He's the chief investment officer of Global Fixed Income at Riverfront Investment Group. Kevin covers equities and fixed income equally at Riverfront, and the firm has almost $10 billion in AUM. I actually want to hear what you have to say about what you think Jim Bullard may have to say, but we're going to get to that in just a second. Uma, we've just had a raft of earnings reports. It continues to be a mixed picture across the board, and so I think there's a lot of investors out there. There's some investors who pick individual stocks, and they like to do that, but there's a lot of investors who like to either play ETFs or play mutual funds or play, just larger indexes, and that seems to be a much harder thing to do right now.
Absolutely. Coming into this year, we were expecting choppy waters. Just given what we were watching with the yield curve starting to invert, we're now very deeply inverted, have been for a while. It's a great time to be a stock picker, right? So at Center Square as active managers, this is what we thrive on. We're really able to find those winners and losers in this environment that are setting up for a really fantastic next year as well. We focus here on real estate, and we're seeing some fantastic opportunities in the listed space from a real estate perspective. I think REITs look really great today and can offer consumers and investors some really fantastic aspects in their portfolios where you're getting that inflation protection, but you're also able to really harness some fantastic trends that we're seeing from a demand perspective that should be fairly immune to some of the cyclical issues that we'll see coming through.
Well, but why REITs? Because I have to say, the whole REIT space has been beaten down just miserably, and there isn't, largely on the expectation that actually real estate is going to lose value over time. Mortgage prices are going to get higher. It's going to get harder to get a loan. It's going to cost more. You just think that it's been beaten up so much? Is that the play?
Absolutely. I think in the selling pressure that we've seen, you've seen the baby kind of get thrown out with the bathwater. And there are some areas within the real estate space that we do anticipate to be more structurally challenged, right? Take office, for example. But on the other side, if you think about just what's happening from a housing perspective here today, we're looking at a very structural undersupply of homes in the U.S. Affordability is really difficult for today people to be able to purchase homes. So a rental housing option is really what a lot of consumers are looking at. And so rental housing today for us is a fantastic opportunity. And at the prices that we're seeing in the listed market, really provides a great hedge from an inflation perspective. Like I mentioned, we're still seeing rental rates increase in rental housing in the mid-teens to 20% today.
Hey, Kevin, we're going to be talking to Jim Bullard in just a little bit. If you had a question for him, what do you want to know right now?
I think I want to know, Andrew, whether or not the Fed is going to be consistent and continue to raise rates and not pause. I think that's the big question that has been on everyone's mind. That's kind of why you saw the equity market take off the way it did over the last week or so, is because they are pricing in the Fed pausing, and the fixed income markets, were expecting a recession. So, what are you, Kevin, personally expecting? We had actually Gabriela Santos on earlier this week, and she said, I don't think they're pausing. She thinks that this fall could be tough in terms of the equity markets as a result of what may ultimately happen with the Fed. Yeah, Andrew, I would agree. One of the things that I think is important is that the Fed wants to get real rates back positive. And if you noticed last week, when there was a thought that there was going to be a pause in the market of their rate hikes, you saw real rates actually go negative at the front end of the curve again. And they have also seen a loosening of financial conditions as far as being availability of credit and things of that nature. And really, the Fed wants to drain the monetary system at this point. And so the way to do that is to continue to raise rates. And I expect that they're going to raise into the end of the year. I expect to see rates at least 100 basis points higher. And right now, Fed funds futures are pricing in 425 basis point hikes through the end of the year. And that's kind of what I had been expecting all along. I did not think that they were going to ever pause here, especially given how high headline CPI is.